Welcome to the Wealth Up Hub, where we talk about money, mindset, and modern investing in a way that anyone can understand. Because building wealth isn't about luck, it's about learning how money really works. Let's get started. Imagine owning stocks of Apple, Google, or Netflix with just $1. Sounds impossible? It's not. That's exactly what you can do with an ETF. Before we dive in, quick heads up. This video is for educational purposes only. It's not financial advice, so always do your own research. With that said, let's look at a common situation many people face. You've been saving, but somehow, your money never seems to grow. Or worse, it's losing value every year. Today, let's talk about how you can achieve financial freedom through ETFs and why traditional saving might be holding you back. Now, let's see why saving your money in a bank might actually cost you. Fact 1. Cash keeps losing value. Every year, inflation silently eats away your money's worth. If inflation is 5% and your cash just sits in a bank, that's like losing 5% of your purchasing power every single year. Fact 2. Saving in a bank isn't always safe. Let's say your bank gives 3% interest, but inflation is 5%. You think you're earning, but in reality, your money shrinks by 2%. Fact 3. In a country, almost 90% of people might stay poor. Only around 4% of the world's population actually invests in the stock market. The rest? They keep saving in cash and slowly lose to inflation. So, what exactly is an ETF? ETF stands for Exchange Traded Fund. It's basically a basket of many top global companies, like Apple, Microsoft, Google, and Netflix, all in one single package. That means, with just $1, you can own tiny shares of hundreds of world-class companies. The ones you use every day, now you can actually own them. Investing is a long game. Investing is not about getting rich quick. It's about staying consistent and letting time do the work. Hold for at least 10 years and let compounding work like a tree that grows and bears fruit. You might be wondering, why ETFs? Why not just buy individual stocks instead? Here's the thing. ETFs are designed to reduce risk by holding hundreds of companies inside one fund. If one stock drops, the others can help balance it out. Some ETFs, like SPY, have survived every major financial crisis since 1993. From the dot-com bubble, to the 2008 crash, to the pandemic in 2020. And they're still standing strong today. In fact, SPY tracks the S&P 500, representing the 500 biggest companies in the US, including giants like Apple, Microsoft, Amazon, Google, and Nvidia, along with hundreds of other industry leaders that power the global economy. Over the last 5 years, SPY has delivered an average return of around 10 to 13% per year, a reminder that steady, long-term investing really works. That's the power of staying invested. When your returns start compounding, your money doesn't just grow, it grows faster over time. Of course, compounding takes patience. The best time to start was 20 years ago. The second best time is today. That's why many investors call ETFs the safest way to invest in the stock market. And don't worry, we'll talk more about how compounding really works and how it can transform small investments into serious wealth in another video. So if ETFs sound like a smarter choice, the next question is, which one should you pick? Let's break down the 3 main types of ETFs most investors start with. 3 ETF portfolio types to explore. 1. Dividend ETFs, for passive income. Choose ETFs that pay regular dividends, like SCHD, VYM, JEPI, SPYI, or SPHD. 2. Growth ETFs, for higher long-term gains. These focus on tech or innovative sectors. Try Q, VGT, or SCHG. 3. Broad market ETFs, for total diversification. If you want exposure to the whole market, pick SPY VOO, VUAA, CSPX, ACWI, or VTI. Now that you know the types of ETFs to explore, you might be wondering, that sounds great, but where do I actually buy ETFs? Good question, and the answer is simpler than you think. You can buy ETFs through most stock market investment apps or brokers available in your country. Just make sure the platform is licensed and regulated. That's what really matters. And hey, if this helped you understand investing better, don't forget to subscribe, hit like, and share this video with a friend who's still saving in a piggy bank. So before we wrap up, let's take a quick look at what we've learned today. First, keeping your money in the bank might not be as safe as it seems, because inflation quietly eats away your savings over time. Second, investing through ETFs gives you access to hundreds of global companies, even with just $1. Third, ETFs help you grow your wealth with less risk, since you're investing in a diversified basket instead of a single stock. And remember, building wealth takes patience, consistency, and time. If you've made it this far, you're already ahead of 90% of people who never learn how money works. So keep learning, keep growing, and don't forget, your financial freedom starts with your first step today. Drop your thoughts in the comments, subscribe for more videos like this, and I'll see you in the next one. The Wealth Up Hub, level up your wealth. Stay curious, stay consistent, and let your wealth grow.